The worst year for stocks since 2008 could still get uglier as the Fed's effort to pull potentially trillions of dollars out of financial markets is hitting full steam. In this video, I'll explain why there might be a stock market pain after the midterm elections. On May 4th, the Fed announced their plan for the quantitative tightening. During a recent FOMC meeting, Fed Chairman Jerome Powell said the quantitative tightening will ramp up and will remove $95 billion per month starting from September. Let's see what the Fed has been doing. Again, if you're here for the first time, you need to know these two terms. When the Fed prints money into our economic system, it's called quantitative easing. When the Fed removes money from the economy, it's called quantitative tightening. From September, let's see how much money the Fed has removed. Data is released on a weekly basis, and I'm going to show what the Fed did till October 27th. All this information is publicly available in the Federal Reserve website, and please take advantage of this information and act accordingly. During Week 1, they've taken $4.2 billion. Week 2, they've printed $5.5 billion. They were supposed to take money out from the economy, but printed more money. Week 3, they've taken $16 billion. Week 4, the Fed removed $18 billion. So for the month of September, they removed $32.7 billion. Week 5, they removed $37 billion. Week 6, they removed $4 billion. Week 10, they removed $17 billion. Week 8, they removed $23 billion. For the month of October, they removed $113.7 billion. So the Fed is ramping up the quantitative tightening. They said they'll remove $95 billion a month starting from September. Yes, they are ramping up. Expect the Fed to increase it further after the midterm election on November 8th. They don't want a huge crash before the midterm elections, which might impact the current administration's chances of winning again. The current administration, who controls the House, the Senate, and the presidency, is aware of it. Expect more quantitative tightening after the midterm elections. Also, we all know that our current administration is using oil reserve from our strategic petroleum reserves, and it's now at its lowest levels since 1984. The bigger problem is they have no plans to refill it. When they try to refill it, it creates more demand for the oil, which will raise oil prices, which in turn increases inflation even more. The Fed is fighting inflation currently, and adding more pressure to the Fed is definitely not a good sign. Goldman Sachs is predicting the oil prices will go to $125 per barrel by the end of the year. For your reference, the current oil price is a little under $80. So all I'm saying is be prepared for the high gasoline prices after the midterm elections. Along with the tightening, we all know the Fed is raising interest rates. The Fed raised 0.75% for the third consecutive time in September, and is expected to raise 0.75% during the next meeting on November 2nd as well. The previous time when the Fed raised the interest rates along with the quantitative tightening was back in 2018 during the Great Financial Recession in 2018. The S&P 500 is already down 21% from its peak early this year after the Fed launched its effort to crush inflation by lifting short-term interest rates. Along with this, like as I mentioned in one of the previous videos, follow the monthly CPI data as well, because the Fed will tighten based on the monthly CPI reports, as Jerome Powell said his target inflation rate is 2%. The CPI report for the month of August is 8.3%, which is very far from the 2% target rate. You might have heard a few people say, "Don't fight the Fed." It's because there's relation between stock market and money printing. As I showed you in one of my previous videos, here's the chart between the two. The blue one is the stock market graph, the gold one is the money printing. You'll see there's a correlation between the two. The Fed prints money, the stock market performs, and when the Fed takes money, it does the opposite. That's why they say, don't fight the Fed. Just look at 2020, how the stock market performed. S&P skyrocketed. It's because the Fed printed record amounts of money. Again, the Fed printed way too much money back in 2020, hence the stock was able to rally in 2020. They didn't have any other option but to print back then because we had lockdowns. We had the unemployment skyrocketing, and the GDP fell by 3.5%. When you print trillions of dollars and inject new money into the economy, that new money is going to inflate everything, including the stock market. Because of the money printing, we're facing high inflation. To lower inflation, what the Federal Reserve is trying to do is remove the money from the economy. Once the Federal Reserve starts to take the money back, then the stock market will go down. But here's the good news. The Fed cannot continue to ramp up the quantitative tightening for 2 years like they say they will. The Fed will definitely pivot sometime next year, and that will skyrocket the stock market, crypto market, overall economy in general. It's because if the Fed doesn't pivot, then there will be economic collapse, so the Fed will pivot. However, the trade-off is going to be inflation. The inflation is going to be worse than the current levels. I'll make a detailed video on Fed pivot in the next few days. Please watch out for the video. Please don't forget to subscribe, and thanks for watching. Until next time.